Hi, folks. This lecture is going to be the first part of International Finance Lecture 7. We will eventually be talking about the exchange rate and factors that lead to different exchange rates under different systems. So let's start off with some terminology. A closed economy is an economy that doesn't interact with other economies in the world. There aren't too many economies that are completely closed. Maybe the best example of a closed economy might be North Korea, but even North Korea trades with China, and they also, believe it or not, trade with South Korea. They allow people or South Korean companies to open up factories on the North Korean side, so they're not completely closed. But they're probably the best example of an economy that comes close to being completely closed. An open economy would be an economy where there'd be free movement of not only goods and services, but capital and labor. There aren't too many economies in the world that are completely open, but most countries in the world have a good degree of openness. I mean, even here in the United States these days, with all the trade talk and everything, we still have a relatively open economy. We don't necessarily have free movement of capital and labor, and we're imposing restrictions on trade, but for the most part, it's pretty well open. The trade balance, that is the difference between exports and imports. So if you took macroeconomics, you might remember we had a formula, an equation that said GDP is equal to C plus I plus G plus net exports. So the trade balance is essentially net exports in 101. We're not going to get into that in this class. Balanced trade, this is a situation where exports and imports are roughly equal to each other. So when you hear Donald Trump or even Bernie Sanders talking about balanced trade, I really think what they're trying to do is take something like the trade balance and make it sound like something, or balanced trade, and make it sound like something like the trade balance, like somehow exports and imports have to be roughly equal to each other. In some countries it is. In the United States, we run big trade deficits, so it isn't, but there's nothing that says we have to have balanced trade. The balance of payments, this is what we're going to spend the first part of this lecture talking about, is an accounting system that tracks transactions, flows of goods, services, and investments around the world. So it includes payments for things like the goods that we import from other countries, and we get paid for our exports. And it also looks at how much American businesses are investing in other countries and how much people in other countries are investing in the United States. All right, so little on the balance of payments. Um, if we have a transaction that causes money to flow into a country, that's reported as a credit, as a plus. If there's a transaction that causes money to flow out of a country, that's recorded as a debit, a negative. By definition, the balance of payments has to equal zero, and we will talk about what happens in a situation where the balance of payments doesn't balance to zero. Since it has to equal zero, we will force it to equal zero by using a thing called statistical discrepancy, but we'll get into that a little bit more as this lecture progresses. So this schematic over here is shows you the balance of payments. Now within the balance of payments, there are two major accounts. We'll go through all of these, but the two principal accounts are the current account and the financial account. The financial account years ago used to be called the capital account, but they split that off. So let's take a look at the current account. The current account looks at imports of goods and services. So we import, goods, which are things we can touch from other countries. We also export goods, things that we can touch to people in other countries. And we import and export services as well. So services could be anything like tourism, insurance, finance, air travel. That would be an example of a service. In the current account, we also have net income from abroad. So what's included in net income from abroad is income and gifts from people in the U.S., people in the U.S. To people in other countries that would show up as a minus. That takes away from money. That's money flowing out of the country. And then we have incoming gifts from people in other countries to people in the United States. That would show up as a plus. So the current account is the largest account of all of these, and we'll get into that in a little bit more detail. But just keep in mind it includes imports and exports of goods and services and income that is earned from abroad. Yeah, anything that we earn from our investments abroad minus what people in other countries earn from their investments in the United States. The financial account has both outflows and inflows of foreign holdings in the United States. So, for example, if an American company were to open up a factory, let's say in another country, let's say like China, that would be an outflow of holdings in the United States. That would show up as a negative. If, on the other hand, let's say a Japanese car maker were to build a factory in the United States to make more cars, that would show up in the financial account as an inflow of foreign holdings of U.S. assets. In other words, people in Japan are going to buy land in the United States. They're going to build a factory. They're going to hire a contractor to build a factory. They're going to put all kinds of factory equipment in there. So they're making an investment in the U.S. And then another thing that shows up in the balance of payments is the change in the official reserve account. So all central banks, all countries that have their own currency, will have other countries' currencies in their official reserve account and a few other things. So those balances can change. That's kind of linked to the financial accounts because a lot of these assets, these financial assets, are actually hedged. So it's not entirely a separate account because changes in the financial account will have an impact on changes in the official reserve account, or can anyway. Then the capital account includes non-produced, non-real assets. These are things like patents, trademarks, things of that nature. It's very small in number. It's measured in the hundreds of millions compared to the billions for these other accounts, or trillions in some cases. And again, the financial account used to be called the capital account, but they broke that out. So we still need this in order to figure out whether or not our balance of payments are balancing. And then finally, if we cannot get the balance of payments to equal zero, we will rely on an account called statistical discrepancy. In other words, because by definition the balance of payments must equal zero, it's a 3-bar equal sign. If it doesn't equal zero, then we're missing something. And what we will do is we'll put the missing amount in statistical discrepancy, and that will get the balance of payments to equal zero. So this is the balance of payments for the US for 2014. What you'll notice over here is that in the US we imported roughly $740 billion more of goods than we exported. We still exported quite a bit, about 1.6 trillion, but we imported about 2.3 trillion. So that left us with a trade deficit in what's called a merchandise trade deficit. In services, we did a little bit better. We exported 711 billion and only imported 477 billion. So, we had a positive balance in services. Again, if you net goods and services, you'll come out with this thing called net exports, which is a difference. Then Americans received about $823 billion from investments that they made over time in other countries that flowed back to the United States. And people in other countries pulled out $585 billion on their investments that they made here in the US. So that'd be things like profits. Let's say for a Japanese company that's making cars in the United States, or for an American company, it could be profits that, let's say, Apple is making from iPhone sales in other countries. That's income that's coming in. Then we've got, so we net these two out, we get net income on transfers. Then there were some other transfers that were negative 120 million. So for this particular year, the balance on the current account was about negative 389 million. Now, on the financial account, we're looking at investments, new investments in other countries. So U.S. companies increase their assets in foreign countries by about 1 trillion. And then people in other countries increase their assets in the United States by 792 billion. So when we net those out, that's 239 billion. The balance on the capital account, we're not going to worry about this in terms of billions. This is in hundreds of millions, so that's why I'm showing it over here as zero. Again, it would be calculated so that we could figure out, how close we are to balancing things, but it's not in the billions, so we're not going to worry about that. And then if you net all these things out, you find out that we're about 150 billion shy of balancing the balance of payments. So for 2014, we had a $150 billion statistical discrepancy to get the balance of payments to balance. And maybe the following year it'll reverse, or maybe they'll figure out why, what we didn't account for. But again, that's how we get the balance of payments to balance. All right, now in the current account, I mentioned that we have the two primary, or there's three different things we have to look at in the current account. We've got exports of goods and services, imports of goods and services, and net income from abroad. So included in this are things like money that we send, people in the United States send to people in other countries in the form of remittances. Also, profits that are repatriated from one country to another. And so this is all going to show up here in the current account. All right, so net income from abroad. What are some of the ways that people can get money from other countries? The difference between net profits made by U.S. companies operating abroad and foreign companies operating in the U.S. So imagine a company like Apple is operating in a lot of different countries. That's not hard to imagine. They sell iPhones, they sell computers, they sell all kinds of things in these countries. They make a profit off of it, and they bring that profit back to the United States. Then that would be booked as net income from abroad. But at the same time, we've got foreign companies that have set up shop in the United States that are producing things here. They're entitled to keep their profit, and so when they take the profit from their U.S. operations and send it back home, that would be netted against what American companies made abroad and sent to the United States. Another thing that goes into net income from abroad is a difference between wages and compensation paid to foreign workers in the United States and U.S. workers in foreign countries. So there may be a case where, like, a U.S. company is hiring foreign workers and they have to pay those workers money, so that would show up in net income from abroad. And then, of course, if a foreign company set up shop in the United States, they'd have to pay their U.S. workers, so that shows up in that account. And then things like gifts from people in one country, including this thing called remittances. That's a thing that set off Donald Trump during the campaign. Remember, he said Mexico is going to pay for the wall, and then he said if they don't pay for the wall, we'll just tax remittances. And a lot of people were scratching their heads saying, what are remittances? That's when, let's say, a worker from Mexico that's working here in the United States decides to send some of the money that they make here in the U.S. back to their family in Mexico. That would count as a remittance. All right, let's talk a little bit about the merchandise balance of trade. This is another thing that has set Donald Trump off. For some reason, he thinks that we should have either a merchandise trade that's balanced or in surplus. We've been running very, very big deficits. What do we mean by a merchandise trade deficits? That is when the value of exports is less than the value of imports. In other words, we're importing more from other countries than we're exporting. I don't know why he considers that to be a problem. I mean, if you're buying something of your own free will from somebody in another country, I don't see the harm in it. I mean, you wouldn't buy it if it didn't have value to you, but he seems to think that that's bad. If the United States exports less than we import, then something's wrong. The people in the other country are ripping us off. That's the kind of language we use. Now, up until about 1970, 1971, the U.S. had a merchandise trade surplus. In other words, the value of goods, things that you could touch, that we were exporting to other countries was greater than the value of goods that we were importing from other countries. That changed, and we've been running deficits ever since. Could we get merchandise trade that's balanced? I suppose we could, but there'd have to be a lot more changes. And tariffs, which we mentioned in lecture 6, would only go so far. There's a lot of reasons why we run a merchandise trade deficit that have nothing to do with low wages in other countries, or people ripping us off. To get to balanced trade, we'd need to make a lot of other changes that would have an impact on the economy. Another thing to mention, exports and imports of military goods are included in the merchandise trade balance. Why do I mention that? Because the United States is by far the largest exporter of military goods, so that helps reduce the merchandise trade deficit that we run with other countries because we sell so many arms to people in other countries. All right, the financial account. So, what would be an example of a transaction that would show up in the financial account? I'll give you two transactions involving the United States and China. So, General Motors actually sells more Buicks in China than they sell in the United States. Buick is a popular car there. And the only issue is that they're making those cars in China. They're not making them in Michigan and exporting them to China. What they do is they've set up factories over the years to build these Buicks in China and then sell it to the people in China. So let's say that GM needed to open up another factory to keep up with demand, and they decided that they'll take a portion of their revenue that they're controlling in the United States and send it to China to buy land and build a factory, hire a contractor to build a factory and put assembly line equipment in there. That would be an example of a transaction that's going to show up in the financial account. All right, so what about an example of a financial account transaction from the Chinese perspective? So I mentioned in international trade that that China's been running a trade surplus with the United States for a long time now. One of the downsides to running a trade surplus is that the value of your currency could rise. Now, China has worked to tamp down in the past, not so much these days. We'll get into that in a moment. China is still a currency manipulator, but not in the way that Trump thinks it is. But anyway, China in the past, when they wanted to keep their currency from rising, would take a lot of the money that was flowing into China to buy goods that are made in China, and they would take that and they'd buy treasuries. Treasuries are government debt. And when they did that, that would have the effect of increasing the supply of their currency, the renminbi, to buy dollars, US dollars. So that would negate a lot of the appreciation in the renminbi. So that would be an example of a transaction that would show up in the financial account. They're not doing that as much these days. All right, financial investment and the financial account. There's two primary ways that people invest in other countries: portfolio investment and foreign direct investment. So, portfolio investment involves the purchase of stocks and bonds in a foreign financial market. In fact, you don't even have to do it in a foreign financial market. If you opened a brokerage account here in the United States and you wanted to invest with your broker in companies in China, they could do that for you as well. They, I guess, would go ahead and buy either stock in a Chinese company or debt that somebody in China, let's say, has issued. That's the way that most average people would invest in another country, is through portfolio investment. Foreign direct investment is the way that larger companies tend to. I'm not saying it's exclusive to larger companies, but if you think about how hard it is, let's say, to buy property in another country, how hard it is, let's say, to build on that property in another country, build a factory, operate that factory. You tend to have to be a bigger player for that. So foreign direct investment would be something that, let's say, Coca-Cola would do if they were building another bottling plant, or let's say GM if they were building another factory to make cars. And net foreign investment is just the difference between assets that Americans buy in other countries and assets that foreigners buy in the US. All right, I'm going to end this first part of the lecture here, and when we come back, we'll talk about the net foreign investment balance.